Hello, and welcome to First Steps to Home Ownership in today's environment. As COVID 19 has impacted the way we conduct business in nearly every sector, today we will discuss how to make the dream of home ownership a reality. My name is Doris Baker, and I am the financial educator at Consolidated Credit. Consolidated Credit is headquartered in Fort Lauderdale. Our mission is to assist families throughout the United States in ending housing and financial crisis and solving money management problems through education and professional counseling. At Consolidated Credit, we provide the following services: budget and credit counseling, debt management services, housing counseling, which includes pre purchase counseling, post purchase counseling, foreclosure prevention counseling, reverse mortgage counseling, and finally, financial education. Ask yourself this question: am I ready for home ownership? To help answer that question, we've listed what are some of the disadvantages of home ownership. Some of the replies have been the cost to own a home, the cost of insurance, and the cost of maintaining a home. But some of the advantages have been home ownership can be looked at as a source of investment. It gives you a certain sense of pride. And also, there are tax advantages to owning a home. In this webinar, we will discuss the necessary steps to become a successful homeowner. First step is attending a HUD approved first time homebuyer class. Our classes are offered through an online means using eHome America. Secondly, meeting with a HUD approved housing counselor and determining housing affordability. With the housing counselor, you will also address credit issues, develop and maintain a budget. You would be setting goals, which in this case would be the purchase of a home. The home buying process will take time. The time it takes is generally based upon the mortgage readiness of the potential borrower. Does the borrower have stable income? Is the borrower creditworthy, or are there issues to resolve? Does the borrower have funds saved towards the purchase of a home? Your housing counselor is the ideal individual and trusted professional to assist you in beginning the process. Here you will see the steps to your new home. The very first step is to meet with a housing counselor. So you would be provided home buyer education through the first time home buyer workshop or class. You would then meet with the housing counselor to gain an insight on if you're ready to make the next step towards purchasing a home. You will get a pre approval before you look. You would have your team, which would include your housing counselor, your mortgage officer, and also your realtor. This is your team, and this is your triangle of protection. Before the price of a property is considered, it is best to know how much of a payment you can safely afford. When calculating an affordable monthly payment, there are four components which must be considered. We will discuss mortgage types a little later. But first, the total gross monthly income has to be calculated. This is more than just adding up your paychecks for a month's period. Your housing counselor will use a special method in order to properly calculate your income. Second, the counselor will calculate your housing or front end ratio, which gives the affordable payment that your gross monthly income. Second, the counselor will calculate your housing or front end ratio, which gives the affordable payment that your gross monthly income could support. Last is the computation of your debt to income ratio, or DTI, or back end ratio as it is sometimes referred to. Housing ratios determine affordability based on gross monthly income and debt load expressed as a percentage. The qualifying ratios differ based upon loan type. For example, conventional mortgages have a 28% housing or front end ratio. For FHA mortgages, the front end ratio is 31%, and for VA mortgages, the front end ratio is 41%. As an example, if a borrower has a housing payment of 1,650 and gross monthly income of 6,283, by dividing the housing payment into the gross monthly income, it would produce a housing ratio of 26%, which qualifies for any of the loan types mentioned earlier. With the previous slide, we provided detail on how the housing ratio and how to calculate that percentage. Now we will take a look at the back end ratio, or debt to income ratio, or DTI as it is sometimes referred to. When a potential borrower exceeds the qualifying DTI ratio, it can cause a delay towards home ownership. The DTI ratio, or back end ratio, determines if the borrower's debt load is manageable. Every loan type has its own qualifying ratio for debt to income, just as with the housing ratio. For example, conventional mortgages have a debt to income ratio of 36 to 45%. FHA mortgages have a 43 to 45% back end ratio, and VA mortgages back end ratio is 41%, which happens to be the same as that product's housing or front end ratio. To compute a DTI ratio for a borrower applying for a conventional mortgage, let's use a gross monthly income of $5,100, a housing payment of $1,428, plus the total of other bills from their credit report, which total $700. We would then add the $1,428 plus the $700, which would bring us to a total of $2,278. Then we would divide $2,278 by the $5,100, which is the gross monthly income. We would get a percentage of 45%. Thankfully, this is within the guidelines of the qualifying DTI ratio for a conventional loan. If the DTI, or debt to income ratio, was just 1% higher, this could end this borrower's application process. That is why it is advisable to visit with a housing counselor prior to running to the bank or credit union for a pre-qualification or pre-approval, and avoiding a hard hit on your credit. At this juncture, you may have to start a serious debt reducing plan of action. Here is where the assistance of your housing counselor will prove to be instrumental. The counselor will be your trusted advisor to assist you in reaching your home ownership goals, and will provide an action plan to offer guidance as you navigate through your plan of successful budgeting and savings, along with debt reduction if applicable. So let's talk about budgeting for home ownership. You may ask, why would I budget? Because people who can account for their money are in control of it. You can't run a business successfully without a business plan, and you can't successfully run your household without a budget. Start this process by writing down your fixed monthly expenses like rent, car payments, and insurance. Then make a list of your flexible expenses like groceries, utilities, gasoline, and medical expenses. Finally, you would list your discretionary expenses such as clothes, entertainment, etc. But before that, let's just get a definition more clearly for a budget. A budget is simply an estimate of income and expenses for a set period of time with designated categories. Here are some keys to successful budgeting. Include the entire family. Pay yourself first. Decide what your goals are. Pay down debt. Include savings reserves. Keep good records and realize it's a long term process. Here's some budgeting tips. Plan for saving to use in emergency. Instead of using a credit card, shop with cash, debit card, or check as often as possible. Pay cash for items under $10 and for eating out. Have only one credit card and plan to pay it in full each month. If you cannot control credit card spending, stop using credit cards. First step to creating a successful budget. Establish your saving goals. In this case, it would be for a home. Know your net monthly family income. That's what you take home after taxes. And base your budget on this income amount. Know what your expenses are by tracking fixed and changing expenses. Make a 1 month budget. Include savings. Remember to pay yourself first. Track your expenses and income for 1 month to see if the amount you budgeted equals what you actually spent. Evaluate your spending choices and decide whether you need to increase or decrease your budget in particular areas. Continue to refine your budget so that the budgeted amounts and the money actually spent are more consistent over time and you are more in control of your spending and savings. Develop a yearly budget customized to your family's needs to meet your savings goals. So let's move on to creating a successful budget. So budgeting is comprised of four simple steps. First step is to add up all your income, which is more than just your paycheck. It includes money from any part time or freelance work, child support you receive, rent you charge, and Social Security and other income from benefits. Once you add all that up, you have your net income. Many of us suffer from hidden expenses. To keep track, think of your expenses in three buckets. Fixed expenses are those you can't easily change. If you pay rent or mortgage, those amounts are the very definition of fixed. But so are car payments and insurance. Let's talk about flexible expenses. Flexible expenses are those you need but can do something about. So, for instance, you need to go grocery shopping, but you can look for BOGOs, you can clip coupons, and you can use strategies for getting more food for less money. Same thing with gasoline for your car and utility bills. Next up is discretionary expenses. Now, discretionary expenses are those you can live without if you really had to. Here we're talking about a movie matinee, a nice dinner out, or that fancy hair salon you like. The total of these categories is your net expenses. Next step is to subtract your expenses from your income. And then after that is done, you are ready to get down to business. So let's just use an example here. If you have $2,000 a month in expenses and $2,500 a month in income, then you're in the black by $500. If those numbers are reversed, then you are in the red by $500. If your income is greater than your expenses, then congratulations. You now have the pleasant task of deciding how to best use your savings. But if your expenses outstrip your income, it's time to set some priorities. You need to decide what steps you can take to either reduce your monthly expenses or increase your monthly income, or maybe even both if you can. Let's break that down. You just figured out how to start your budget. Now let's talk about maintaining it. It may help to keep a spending diary for a month or two. This means saving your receipts and writing down the items and amounts for everything you spend. If that sounds like a chore, there are free, secure online tools to help you monitor your spending. One of the most popular is called Mint, but there are many others, sometimes offered through your bank. So go ahead and check those out. Check with your bank first. Every time you put gas in the car, pay the lawn or pool service, rent a movie, or grab a soda or coffee, make sure you don't leave anything out. Don't forget about your morning cup of coffee or your newspaper. The key is to include everything you spend money on. Look back over your check stubs or bank statement to see where you've been spending money. Check out your bank's online banking platform. Some banks have good tools to help you track where you are spending your money. So, what's next, you may ask? Forgo instant gratification for your long term goals. Pay yourself first. Strive to put at least 10% of your weekly, bi weekly, or monthly paycheck into the bank. You can do it. So here are some common saving goals. We know that your main goal, because of this presentation, should be to save for the down payment of your first home. But here are some other goals. Save up an emergency fund of cash, 3 to 6 months of living expenses. You can save to buy a car, maybe even buy a car for cash. Save enough money to take a vacation without the need of credit cards. Save enough for the down payment on your first home to be purchased in a couple of years. And here we have some convenient ways to save money. Pay yourself first. Auto pay from your paycheck into savings account every month. Minimize your use of credit cards. Review your insurance coverage as well as your deductibles. Review your W-4 exemptions. Save on utilities by conserving energy and water. Note which habits cost you money and reevaluate their importance. Call your credit card company and request a lower rate of interest or monthly minimum payment. Establish a gift giving agreement with friends and family. Use a list when grocery shopping and begin to weigh needs versus wants. And we're going to look at that a little closer. The next time you're tempted to buy something, stop and think about the following. Think about, do I really need this item? Is it really worth all the time I spent making the money to pay for it? Can I use my money in a better way right now? Do I really need to buy the priciest item, or will a lower cost item serve me just as well? Can I really afford this right now? Will the item be on sale soon? Should I wait? Do I really need a name brand item, or will a store brand serve my purposes and save me money? What do consumer magazines say about the item I'm considering? Do I know anyone who already owned this item? Do they think it was worthwhile to buy, or do they regret their purchase? These are all questions that you can ask yourself when you're tempted to make a purchase. So now let's move on to credit. What is credit? Credit is the ability to borrow money. We all need to know that credit is a privilege, it's not a right. This is one of the most important things when it comes to buying a house. Without having your credit in order, you will not be qualified for anything at your bank. We have our we have wonderful lenders that we work with that would be willing to explain what they are looking for. But before you go into the bank for your pre-approval, you will definitely need to get your credit in order. You're here because you're thinking of buying a house, right? So first things first, how is your credit? How do you know your credit score is right? Do you know what it is right now? When was the last time that you pulled your credit? Because believe me, when you begin this search, your lender will be pulling that report and checking that score the minute you sit down across for them. So that means you have to know what is on your credit report and where your score is. We will discuss what factors affect your score. Some people have excellent credit, others not so good. Then bad or no credit or a thin credit file. So if you're in the excellent to good credit category, then you will obviously need to maintain that. If you are in the fair to poor category, then you will need to take control and work on addressing your credit issues. If you have no credit or what is called a thin credit file, then you will need to start establishing some credit. Now, you're probably asking how if no one will extend credit to me. Well, you can start with a secured card and build from there, and we'll talk about that a little later. So let's talk about the 5 C's of credit. The 5 C's are capacity, character, collateral, condition, and credit history. Let's address capacity. Capacity is asking, how is your financial health? Can you repay the debt? How long have you been at your present job and what is your salary? How many dependents do you have? How many other loan payments do you have? What are your current debts? What is your debt to income ratio? Your credit character. Here is something that would be asked. Do you intend to repay your debts? That's what your credit character is going to show. Have you used credit before? Do you pay your bills on time? Do you have a good credit report? Does it look like you possess the honesty and reliability to pay credit card debts? How long have you lived at your present address? Collateral. What are your resources for repaying the debt? What property do you own? Do you have a savings account? Do you have investments to use as collateral? Condition. Condition considers overall condition of the borrower, the lender, and the economy. So there are instances when institutions are not issuing credit or making loans due to factors totally unrelated to you. And your credit history, which is measured by your credit score. Now, your credit history can be summed up as a snapshot of a person's credit picture. Numeric value is assigned based on borrower's level of credit risk. Higher the score, requests for credit will more likely be approved and at a lower interest rate. Credit scores change for good or bad over time depending on credit history. So we just reviewed the 5 C's of credit. Now let's talk about that credit report. When you pull your credit report from annualcreditreport.com, You will get only your credit report and not the score. You can obtain your score from a number of different channels, but it's more than likely that you will have to pay for it. You have to remember also that before you focus on what your credit score is, you are going to want to go over your report with a fine tooth comb because the information on your credit report directly affects your score. There are a few credit card companies that offer you a free score with your account. Let's talk about information on your credit report. First is the personal information. This is compiled from the credit applications that you have filled out and normally include name, current and recent addresses, social security number, date of birth, and current and previous employers. Credit scoring results and summary. This section contains the summary of all of the factors that make up your credit score, called reason coded. I will have an example of these codes in the notes. This shows the major contributing issues that will help explain to the consumer why their score may be less than perfect. Next on your credit report are trade lines and derogatory accounts. The bulk of your credit report consists of details about credit accounts that were opened in your name or that list you as an authorized user. The account details, which are supplied by the creditor, include the date the account was opened, the credit limit or the amount of the loan, the payment terms, the balance, and a history that show whether or not you've paid the account on time. Closed or inactive accounts, depending on the manner in which they were paid, stay on the report 7 to 10 years from the date of their last activity and sometimes indefinitely. Next on the credit report, you will see inquiries. The three credit bureaus record an inquiry whenever your credit is generated for another party, such as a lender, service provider, etc. Inquiries remained on your report for up to 2 years, but only impact your score for 1 year. Public records. In this section, you will find public records obtained from a government source, such as a court of law, and these could include liens, bankruptcies, and overdue child support. Most public records stay on the credit report for 7 years, except bankruptcies, which stay on for up to 10 years from the date of dismissal or discharge. As I stated a couple of minutes ago, you can and should dispute any items that are not yours or that are inaccurate. You can either write to them or you can do the dispute online. If you are going to send a letter, you need to make sure that you mail them certified return receipt. We are in the technology age, and doing everything online is easier and more convenient. Each credit bureau has their own website, and on each site has the option for you to dispute. As you can see on the picture on the screen, it says get started in 3 easy steps, and they are easy. Once you have your report and you have the accounts you want to dispute, the system will walk you through it. So let's talk about credit scores. Basically, a credit score is a number that summarizes a consumer's credit risk and can change due to factors. These factors are based on the things you do and your behaviors. Now, the whole point of this webinar is to help you increase your credit score for the purpose of home purchasing. That's a portion of this webinar. The first and most obvious thing to do is change. I just told all of you that your credit score is a three-digit number that changes due to certain factors, and that those factors are based on the things that you do and your behavior. So, with that being said, the first thing to do would be to change those behaviors. I know that this is probably easier said than done, but as important as credit is to our lives, then change is what we will have to do. So if you know that you used to use your credit cards almost to the limit, then that would have to be something you need to change. We're going to get into what factors into your score in more detail in the next slide. And one of those things is high balances close to the limit. Going back to bad credit card spending, if you realize that you can't handle it, freeze your cards in a block of ice in the freezer so that you won't be able or tempted. And if you have a balance, you can now work on paying it off. As you can see, the largest chunk of what makes up your score is your payment history. But you also have to pay attention to the 30%, which is amounts owed, and that 10% of types of credit in use. That 40% is also very important in impacting your credit score. That represents how a person uses their credit. And the 30% amounts owed, they want to know or see how much is too much. How much is owed as a percentage of the total available credit on each account, in total amount owed compared to total available credit by type of credit, number of accounts with balances, types of credit. That 10%, is there a healthy mix of revolving and installment debt? Number of national bank credit cards or cards issued by banks. Number of installment debts, car loans, compared to revolving debts, retail cards. Now you have to remember that a FICO score takes all of these factors into consideration, not just one or two. The importance of any factors depends on the overall information in the consumer's credit profile. The levels of importance shown in the diagram are for the general population and will have different effects on different credit profiles. What's not included in your credit score: race, color, religion, national origin, sex, and marital status, age, salary, occupation, or employer, and where you live. So let's just take a closer look at those percentages rather, that make up your credit score. As we already discussed a little bit, but just here for you to see, payment history, 35% on its own. That's the timeliness of your bill payments. It includes late payments, bankruptcies, and delinquencies. Amounts you owe, we spent a little time on that. 30% includes the amount of debt you have accumulated on your credit cards, as well as how much you owe on installment loans compared to the original amounts of the loans. The length of credit history is 15%. It takes into account how long you have had credit accounts and how often you use them. New credit, 10%. Opening a number of new credit accounts over a short period of time may be detrimental to your score. And we talked a little bit earlier about type of credit in use, credit cards and loans, such as installment loans, mortgages, and car loans. Most lenders like to see a mixture of these items. Build positive new credit references. The best thing you can do to rebuild your credit is use credit carefully and always pay your bills on time. Consumers who are proactive about rebuilding their credit after problems have occurred can see significant improvement in as little as a year or two. Here are some tips. Lenders will want to see at least a couple of recent credit accounts paid on time. If you still have open accounts, use them periodically for things you would buy anyway, then make sure to pay the bill well before the due date. Carrying balances and paying interest is not necessary for rebuilding good credit. If you don't currently have any credit cards, it may be a good idea to get one. However, avoid guaranteed approval credit cards that cost a couple of $100s in fees. A better bet is a legitimate secured card where you place a security deposit with the lender in exchange for a major credit card with a modest credit limit. Shop for one at www.bankrate.com. You can also go to myfico.com or to creditcards.com. And of course, you can visit your own bank or credit union. And last tip into rebuilding or building positive new credit references, never pay a bill late. Now, if you were to go to myfico.com, you would see that they discussed in detail how secured cards can help you to establish or reestablish good credit. So, a secured credit card is a card that has its credit limit secured by a deposit that you make into a special savings account. Your available limit is based on how large a deposit that you make. It can be anywhere from $300 up to $2,000. Some may be even higher. You would have to find out from the lender because if you have a higher limit, then I would hope that you are paying your other bills as well. Remember that 35% from earlier, the money that you deposit into your savings account for your credit limit is there just in case you happen to default on your payments. Just remember that you still have to make your payments every month when you use that secured card. If you are looking for a secured card, the first place to start would be your bank. Ask if they have them and also ask if they report to all three credit bureaus. And as I said before, you can check online at sites like creditcards.com or even nerdwallet.com to see who else offers secured cards. A credit rebuilder loan is a small loan made by some credit unions and banks in order to help you build credit. You can check your local credit unions or banks to see who may offer these services. In most cases, you need to have an account with them for a certain amount of time with no overdrafts, etc. Not all credit builder loans are the same. In some cases, it's not actually a loan where you get the money. It may be an account through the bank or credit union where you make monthly payments towards, and at the end of your term, they will issue you a unsecured credit card for the amount. It could be anywhere from $300 to $600 depending on the institution. In other cases, you get the money from the bank and you make the monthly payments until paid off. This is also a great way to show that you're building or rebuilding your credit by making on time monthly payments and a mix of credit if you happen to have credit or store cards. Alternative credit scoring is a great option for those with limited to no credit or bad credit. This is a way to help build non-traditional credit. This report is not associated with the three credit bureaus, but it is being used more widely now for things that your traditional credit is pulled for. Many lenders are using for deciding factors before issuing credit. What can be added to these files are rent, utilities, car insurance, your cell phone, gym memberships, monthly subscriptions, Netflix, Hulu, and etc. PRBC is an alternative credit score site. Now, let's wrap this up with your credit responsibilities. Borrow only what you can repay is responsibility number one. What this means is do not charge anything on your cards that you cannot repay at the next month's bill or prior to the next month's bill. Read and understand your credit card contract. Yes, get out your magnifying glass and read the small print. Pay debts promptly. We can never stress it enough. Do not be late on any of your payments. Notify your creditor if you cannot meet your payments, and I'm sure they'll be willing to work with you. So that concludes our webinar today. First steps to home ownership in this environment. I hope that something has been shared today that will be helpful to you. If you have any questions, feel free to call us. You see the number there on your screen, and you can email us as well, and we'll be happy to answer any of your questions. Again, thank you for attending, and have a great day.